Everyone tells you to invest in the S&P 500. Graham Stevens says it, Andre Jick says it, Reddit says it, your financially literate friend says it at dinner, and they're all right. It's averaged around 10% a year for nearly a century. It beats most professional fund managers over any 15-year window. It requires nothing from you except consistency. Fine, you're convinced. You open a brokerage account, and then you search S&P 500 ETF, and two tickers come up, VOO, SPY. They look completely identical. Same index, same 500 companies, same chart, basically. And you sit there, Googling the difference, get three contradictory answers, and either pick one at random or close the tab and do nothing. I did this. Genuinely embarrassing how long I did this. So I went and actually settled it. Morningstar ratings, the legal fund documents, Wall Street, Reddit, the YouTube finance community, the actual fee math projected 30 years out. Every angle I could find. My answer right now, before anything else, for most people watching this, VOO is the right call. I'll tell you exactly why. I'll also tell you the specific situations where SPY is genuinely the better choice. The answer isn't one size fits all, but it's far clearer than the internet makes it seem. Here's the thing that actually surprised me when I ran the numbers. VOO and SPY track the exact same index, the S&P 500, same 500 companies, Apple, Nvidia, Microsoft, Amazon, same weight, same everything. On any given day, their returns are essentially identical, so why does it matter which one you pick? One word, fees. VOO charges 0.03% a year. SPY charges 0.945%. The gap between them is 0.06%, which sounds like a rounding error. On $10,000, that's about $6 a year. I genuinely laughed out loud when I first calculated that, but on $500,000 held for 30 years at a 7% annual return, that same 0.06% gap compounds into over $67,000 in lost wealth. $67,000, not from one bad stock pick, not from a market crash, from a fee difference most people would describe as negligible, quietly compounding against you for 3 decades. That number is what made me take this question seriously. Now let's understand what you're actually choosing between them. Both VOO and SPY are ETFs, exchange-traded funds. One share, instant ownership of all 500 companies in the S&P 500. Apple, Nvidia, Microsoft, Amazon, Alphabet, the whole index in a single purchase. SPY came first. Launched in 1993, the literal first ETF ever created in the United States. State Street built it, and they built it the only way the law allowed at the time, as something called a unit investment trust. That legal structure is SPY's original sin, and it costs you money to this day. A unit investment trust from 1993 operates under rules written before modern ETFs even existed. 2 of those rules matter for your wallet. First, SPY cannot reinvest dividends. When the 500 companies in the index pay out, SPY has to hold that cash in a non-interest-bearing account until its quarterly distribution date. In a rising market, that's your money sitting idle for weeks at a time instead of compounding. Deadweight. Second, SPY cannot lend shares. Modern ETFs lend their holdings to short sellers and collect a small fee that flows back to shareholders. Essentially a rebate that offsets fund costs. SPY is legally prohibited from doing this. That revenue just doesn't exist for SPY shareholders. VOO launched in 2010, Vanguard's modern open-end fund structure. It reinvests dividends immediately. It lends shares and passes the income back. And it has now crossed $1 trillion in assets, the first standalone ETF in history to hit that milestone. Morningstar looked at all of this and gave VOO a gold analyst rating. SPY got silver. The reason they gave is exactly what I just described: cost and structural efficiency. On the surface, identical. Under the hood, genuinely different machines. So looking at these head to head, I went through every category I could find. Here's what I actually found, and one of the answers genuinely surprised me. Fees and why this is the whole argument. VOO, 0.03% per year, $3 on every 10,000 you invest annually. SPY, 0.0945%, about $9.50 per 10,000. 1,000. SPY costs roughly 3 times more for exposure to the exact same 500 companies. You get nothing extra for that premium as a long-term investor. VOO wins on fees, and it isn't particularly close. Performance. Over the last 10 years, both returned roughly 14.5 to 15.6% annualized. The gap is almost entirely explained by fees. No hidden alpha on either side, no secret sauce, just the fee difference compounding quietly in VOO's direction every single year. Liquidity, the real reason SPY still has 785 billion in assets. Here's what most videos miss. SPY trades 25 to 30 billion dollars in a single day. It is the most liquid ETF on the planet, and that matters enormously, just not to most people watching this. For someone investing a few hundred or a few $1,000s a month, completely invisible advantage. Your order fills fine regardless. For an institutional trade desk moving 50 million in a single block, the execution advantage from SPY's tighter bid-ask spread more than offsets years of fee savings from switching to VOO. That's who SPY was built for. That's who's keeping nearly $800 billion in it. It's not retail investors. Options market. SPY has the deepest options market in the world. Daily expirations, including zero-day options that expire same day. Massive open interest across hundreds of strike prices. Tight spreads throughout. If you sell covered calls, buy protective puts, or run any structured option strategy against the S&P 500, SPY is essentially mandatory. VOO has options, they just lack the depth and liquidity for serious derivatives work. Dividends. Nearly identical yields. VOO's lower expense ratio means marginally more stays in your pocket. Not a swing factor on its own, but it always tilts VOO's direction. Morningstar's cool, gold for VOO, silver for SPY. Make of that what you will. The alternatives. When I searched this topic, YouTube kept serving me VOO versus SPY versus QQQ, and VOO versus SPY versus VTI. So let me clear those up honestly and fast. VTI. And I want to start here because this is the conversation I actually think is more interesting than VOO versus SPY. Vanguard Total Stock Market ETF. Same 0.03% fee as VOO. Instead of drawing an arbitrary line at 500 companies though, VTI holds the entire US market. Large cap, mid cap, small cap, all of it. Historically, the performance is nearly identical to VOO. A lot of evidence-based investors prefer it precisely because you're not artificially capped at 500. If you've never seriously considered VTI, I think you should. It gets underrated in most of these comparisons. IVV, BlackRock's S&P 500 ETF. Same index, same 0.03% fee, and modern structure. Morningstar, gold rating. If you're in the Fidelity or iShares ecosystem, IVV and VOO are the same fund in different wrappers. Pick whichever your brokerage handles most naturally and stop thinking about it. This is not a meaningful decision. SPLG, State Street's lower cost S&P 500 fund, a 0.02% expense ratio, 1 basis point cheaper than VOO, same index. It's legitimate. The real world edge over 30 years versus VOO is marginal. I wouldn't change brokerages for it, but if you're already there, it's a fine choice. QQQ. I need to be direct about this one because I see the confusion constantly. QQQ is not an S&P 500 fund. It tracks the NASDAQ 100, the 100 largest non-financial NASDAQ companies. Heavier tech tilt, higher concentration, higher fee at 0.2%. It crushed VOO during the AI and tech boom. It got crushed during downturns. If you're buying QQQ thinking it's a more aggressive version of VOO, you're actually making a concentrated sector bet without fully realizing it. Know what you own before you buy it. Your situation. Now, here's where the answer stops being universal. You're investing every month, building towards retirement, thinking in decades. VOO. The fee advantage compounds for you. The structure is cleaner. SPY's liquidity advantages are completely invisible to you. You are not the customer SPY was designed for. You're investing inside a Roth IRA or 401k. Still VOO. Inside a tax advantage account, the structural differences in tax efficiency between the two are negligible. Cost is the only remaining variable, and VOO wins on cost. You actively trade options, covered calls, protected puts, complex spreads. SPY. The options market depth is genuinely in a different league. Tighter spreads, daily expirations, enormous open interest. The 0.06% annual fee premium is irrelevant when your holding period is measured in days or weeks, not decades. You want the absolute lowest fee that exists. Look at SPLG at 0.02% or zero fee products like Fidelity's FNILX. Fair warning on the zero fund ones. They track a proprietary index, not the official S&P 500, and most are mutual funds rather than ETFs, so you trade intraday flexibility for the savings. Worth knowing before you commit. You're investing from outside the US. You likely can't buy VOO or SPY directly. EU and UK regulations, PRIIPs, and MIFID2 block most European retail investors from purchasing US domiciled ETFs outright. The equivalent products are VUSA from Vanguard and RUSA from iShares. Same S&P 500 index, locally regulated wrappers. Trading 212, Trade Republic, and Interactive Brokers are the main platforms to access them. The criticism nobody mentions. I want to be upfront about something coming from a video that just spent over 6 minutes making the case for VOO. The just buy VOO advice from Grain Steven, Andre Zick, the Reddit personal finance world is mostly right. I'm not here to knock it, but it has real blind spots that nobody in that ecosystem talks about, and I think you deserve the full picture. The concentration problem. The S&P 500 sounds diversified. 500 companies, that sounds like a lot. It isn't really. The top 10 holdings make up roughly 35% of both VOO and SPY. Right now, you are heavily concentrated in a small cluster of mega cap tech. Nvidia, Apple, Microsoft, Amazon, Alphabet. That is a bet that AI and tech leadership continues. It's been a well-rewarded bet historically, but it is a bet, not diversification. VOO is a position, not a portfolio. Buying VOO gives you US large cap stocks. That's it. No international, no small cap, no bonds, no alternatives. Most serious financial advisors would tell you an S&P 500 ETF is where a portfolio starts, not where it ends. VOO and chill is a fine first step. It's incomplete as a final answer, and a lot of people treat it as the final answer. The valuation problem. Cap-weighted indexing means that every dollar you invest automatically buys more of whatever has already gone up the most. When US large cap tech is expensive, and by most historical measures right now it is, VOO systematically loads you up on expensive US large cap tech. That's not a reason to avoid it, it's a reason to understand what you actually own. For SPY specifically, the critique is simpler. It's an excellent product that gets sold to the wrong customers. If you're a long-term buy and hold investor with no option strategy, you're paying a fee premium every year for infrastructure you will never use. That's the whole problem with SPY for most retail investors. The 5 key mistakes. Mistake number 1, holding SPY for decades because it was the first name you recognized. SPY isn't a bad fund. A lot of people bought it first because it's the most famous ticker in this space, and that's fine. But if you're a buy and hold investor with no option strategy, you're paying a fee premium every single year for a liquidity advantage you'll never touch. VOO and IVV do the same job for less. Mistake 2. Selling SPY to switch to VOO without running the tax math first. This is the one that actually trips people up in practice. If you hold SPY in a taxable brokerage account, selling it to buy VOO triggers a capital gains event. Depending on how long you've held it and your tax bracket, that bill can easily exceed years, sometimes a decade, of fee savings from switching. Run the actual numbers before you move. Talk to a tax advisor if the position is significant. Switching funds isn't always the right move, even when VOO is the better long-term vehicle. Mistake 3. Thinking VOO means you're diversified. Owning VOO doesn't mean you're diversified. It means you own 500 US large cap stocks with heavy tech and growth concentration. International markets, small caps, bonds, real assets, none of that is in VOO. It's a starting point, not a complete plan. A lot of people in the comment section of finance videos treat it as the latter. Mistake 4. Buying QQQ as a higher upside version of VOO. QQQ has outperformed VOO meaningfully during tech bull runs. It has also significantly underperformed during downturns. It's a style bet, not a diversified core position. If you're buying QQQ as your S&P 500 equivalent, you don't own what you think you own. Mistake 5. Waiting to decide. This one is the most expensive mistake on the list, and nobody talks about it in the VOO versus SPY debate. The fee difference between these two funds is real, but is measured in basis points. The cost of sitting in cash while you research the perfect ETF is measured in missed market returns, and that clock starts the day you could have invested a bit different. Both funds are excellent. Pick one and start. You can optimize later. Done is better than perfect here. My honest verdict. I want to be clear before I give you my take. I'm not a financial advisor. This is research I did for myself and I'm sharing as clearly as I can. Verify current fees and tax rules before acting on any of it. Talk to an actual advisor if your situation is complex. Here's where I actually land. VOO is the right default for most people watching this. The fee is lower, the structure is cleaner. The Morningstar Gold rating reflects something the underlying numbers confirm. If you're building retirement wealth, contributing monthly, thinking in decades, not watching the ticker every day, VOO is the better machine for the job. SPY is the right instrument for a specific use case. Active trading, option strategies, institutional hedging. If that's your world, SPY's liquidity and options depth are genuinely unmatched, and the fee premium is irrelevant at short holding periods. If you're stuck between VOO and IVV, stop. They're the same fund. Pick whichever your brokerage makes easiest and move on. If you haven't seriously considered VTI, I think you should. Same expense ratio as VOO, broader exposure, nearly identical historical returns. It's the conversation I find more interesting than VOO versus SPY, honestly. And the thing I want to leave with you, the thing I wish someone had said to me when I was sitting there paralyzed between two tickers that looked completely identical, the gap between VOO and SPY is real. The $67,000 number I showed you is real, but it's still smaller than the cost of not starting. The most expensive mistake in this video isn't choosing SPY over VOO, it's choosing neither because the research took too long. Pick one, start today, fix it later if you need to. What are you in? Drop it in the comments. VOO, SPY, VTI, or something else entirely. And if you've ever switched from one to another, I want to know what made you do it. Those threads always end up being the most useful part. Disclaimer, nothing in this video is personalized financial advice. I'm sharing what I found through my own research, not telling you what to do with your money. Fees, fund structures, and tax rules change, so always verify current numbers directly with Vanguard, State Street, and iShares before investing. If you want more of this, every perspective, real numbers, one honest answer, no one paying to be recommended, subscribe. That's every video on this channel, no exceptions. See you in the next one.